Welcome traders. In this video we're going to take a look at two other patterns, the exhaustion trade and the tick divergence trade. In the exhaustion trade, the trade occurs when price reverses from a minor zone of support or resistance. The price can test a high or a low, or it could trade all the way to the blue counter trend zone. The tick divergence trade occurs when price trades to a blue zone with or without exhaustion, and the NYSE tick value is divergent. Let's take a look at the exhaustion trade a little bit more in depth. The exhaustion trade occurs when price reverses from a minor zone of support or resistance. When it does that, the price can test a high, and that is where you will first see the exhaustion trade signal first come onto the screen. Or it can trade all the way to a blue counter trend zone. This is the only instance where ZoneTraderPro will actually move a signal because of the definition of an exhaustion trade. This is considered a reversal pattern, and it usually occurs after a strong trend and becomes a topping or bottoming pattern. Here are two examples of exhaustion trades. The first is a successful trend reversal where a tick divergence and exhaustion pattern had developed at a blue counter trend zone. The second is an exhaustion trade which occurred after a test of a low. As you can see, both of these trades were extremely profitable. However, this is what we need to be aware of. If the exhaustion trade is taken from a test of a higher low, we possibly have to use a bigger stop. All of those trades, however, by definition are winners. Look at after the first tick divergence exhaustion trade was taken, and as it was about 2 points from the blue counter trend support zone, you see the market pop for 2.5 points. This is normal and would almost be expected as a reversal pattern. However, if you did develop order flow at that location, you are likely going to have to take that trade, but be prepared to exit it if you developed opposing order flow as it traded 2.5–3 points higher. The tick divergence trade occurs when price trades to a blue zone and the NYSE tick is also divergent. It does not need an exhaustion pattern when it trades at the blue zone. You do, however, need to have a data feed that supplies you the $ tick data. The numbers on the chart that you see here are the $ tick. If you see a tick divergence label that turns red, that is because at that bar, that is where the tick divergence pattern became non-divergent. And ZoneTraderPro leaves that on the chart so that you understand that nothing disappears from a chart if something goes against you. What we also need to be aware of is that the $ tick can remain divergent and trade through a blue zone and continue to trade either higher or lower. The label will continue to move until the $ tick becomes either non-divergent or we have a valid zigzag. To set up the charts for these trades, on the zigzag ZTP indicator for a 150 tick chart, we put a deviation point of 1.25 in the indicator. On the 500 tick chart, we put a value of 2.5 for the deviation points on the zigzag ZTP indicator. For the ZoneTraderPro indicator on a 150 tick chart, we put 5 for the zigzag ticks, and on a 500 tick chart, we put a value of 10 zigzag ticks. I'd like to take this time to remind you why we use these values. There's nothing special about a 150 tick chart or a 500 tick chart. They just look normal to me. And you can change these without any problem. You do not want to change the zigzag tick values, however, that we've gone over here. However, the reason I chose these values is because ZoneTraderPro draws a new zigzag based on the close of a bar. This is why we don't want numbers that are way out there crazy of say 1,000 ticks or 1,500 ticks. We want to see where the next zones are going to be printing, And to do that, we need a bar to close above or below a existing zone. So that's why the numbers that I use are important. There are three reasons why we need two charts. The larger time frame 500 tick chart removes some of the noise and in some cases provides an exit target. We use both charts to also verify that there's not a high risk pattern such as a strong trend trade occurring on either chart. On this chart you can see that we had entered a strong bearish trend on the 500 tick chart. When we look at the 150 tick chart of the same trade, we see that the 150 tick chart was giving us a tick divergent exhaustion pattern, and that pattern eventually failed with the market trading down to strong trend support. So this would have been a disqualifier for this trade because of what the 500 tick chart was telling us. So by using both charts, we eliminate trading signals that are identified as additional risk, and we incorporate that into our trading plan so that we are not taking anything but the most optimal trading situations. To summarize, we see less noise on a 500 tick chart, and it gives us a bigger picture. We can also use it to develop a target to exit a trade. This is a chart of Thursday, December 27th, a day following the historic 1,000 point Dow rally, and a day itself which was also extremely volatile, with the Dow trading over 600 points down to ending almost 300 points up. As you can see, the market is responding to the ZoneTraderPro patterns as if it was a normal day. We see we entered a strong trend. We reversed at minor support where you see the negative 19. We traded into a tick divergence exhaustion trade, which gave us only about 3 points because the market was still strong. We then traded into an exhaustion pattern, which was a top, and eventually traded down from there about 20 points. That's not to say that trading down 20 points in an hour isn't crazy, but ZoneTraderPro is accurately picking up the signals, and if we use our charts as designed, we can make trades from those charts. So what are the risks in an exhaustion and tick divergence trade pattern? The first two risks are that any reversal from minor is a sign of a strong trend, and price can trade through that blue counter trend support zone and down to at least a pink strong trend support or resistance zone. The second thing can be that the $ tick can remain divergent and still trade through an exhaustion zone. Just because the $ tick is still divergent doesn't give you an automatic license to take a trade and guarantee that it's going to work. The next thing you have to know about an exhaustion and tick divergence pattern is that there are significantly higher risks for taking any trade after these patterns occur. It is possible to have both a trend or a reversal pattern, or actually both patterns occur after an exhaustion or a tick divergence trade. This higher risk has not been studied on a 500 tick chart, and it is something that you should study before taking that type of trade. And as you can see, I think this is extremely important information that you need to know. So what do we look for in a trade? On a 500 tick chart, we are looking to have an exhaustion trade pattern because that is going to give us the largest reward for our risk. We'd also like tick divergence if that is possible with that trade. Next, we're going to look at a 150 tick chart and look for any red flags. Going into that exhaustion trade, there were no red flags. We in fact just had a tick divergence pattern occur. There was, however, a red flag on the trend trade that followed because there was a strong trend reversal on the 150 chart where that had occurred. The only other red flag on this chart was actually in our favor, and that is that we entered a strong bearish trend after we had entered the trade. On a point and figure chart, we want to see divergent delta strength. At the TickDivergence exhaustion trade, we had a green up bar with a red delta strength number on top indicating the selling. If we were looking to make a buy, we would be looking for a down bar with a green delta strength indication on the buy. And the last thing we're going to look for is we're going to look to the order flow chart and see that there is hopefully delta strength there and order flow patterns at the point of the trade. This is the exhaustion patterns that occurred at the top in the trades that I showed you earlier from December 27th. So when we've met all four of the requirements on the trade, you can see setups like this 20-point move that we had today on December 27th. I'd like to thank you for taking your time in watching this short video on the exhaustion and tick divergence patterns. And as usual, if you should have any questions, please be sure to give me a call. Take care and have a good day.